Hello and welcome back to another lecture of security valuation. Till last lecture we studied dividend based model. In this lecture we will study earning based model. Okay, this model is not frequently asked in exam as this model is already tested in your inter level. Okay, so if you see all these formulas in this part, it is mostly of your CA inter syllabus. Okay, like this earnings growth model or EPS growth model. This model, if you see this formula, EPS into 1 plus G divided by ROE minus G. This formula you might have learnt in your CA inter. Okay, so we will not dive deep into it. In our module also, just a few part is given. Okay, not much is given, only just one formula is given there, and they have said that everything is covered in your CA inter part. Okay, in detail it is covered in CA inter part, and it is also not asked in exam. In final exam it is not asked. So we'll just brush through the formulas in this part and we won't do any questions in it. Okay, we'll just see how this formula is. I'll just read the formula. If you want to find the intrinsic value using the earning based formula, we have to use this formula, which is EPS into 1 plus G divided by ROE, not KE. Okay, ROE minus G. Okay, I don't know the mindset of the author who derived this formula, so I'm just mugging it up. Okay, so the next one is P multiple approach. This approach, it is just a ratio. Okay, in ratio we have seen, right, what is P ratio? P ratio is price upon earning ratio, right? That is MPS upon EPS ratio. So simply they have given this MPS is equal to PE into EPS. This is basic one. And Gordon's model is R D1 upon KE minus G, right? We have already seen this in dividend based model, so here we'll just brush it up. Okay, what it is EPS into 1 minus B, where 1 minus B is equal, B is retention. Okay, 1 minus B will be your dividend payout ratio. Okay, so EPS into 1 minus B means it is D1. Okay, it is dividend payout ratio. 1 minus B means dividend payout ratio. So D1 upon KE. KE remains constant in your formula. Okay, KE means your required rate of return minus B into R. B means retention ratio, R means ROE. We have seen this kind of sum in dividend based model also. Okay, so or simply D1 upon KE minus G. EPS into 1 minus B divided by KE minus B into R, or D1 upon KE minus G. Okay, next comes Walter's model. Okay, Walter's model is the favorite sum in CA inter. Okay, every time they ask it for 5 marks and it is bonus marks. Here you just have to put the formula and input values in it and you'll get the answer. What it is, we'll just see. D money DPS, E minus D. E minus D is EPS minus DPS. Okay, and R, we multiply this by R by K. R is ROE divided by K means your required rate of return, divide the whole by K. Okay, I don't know the derivation of this formula. Okay, just mark it up the formula. And this one, yield on share approach. Okay, yield on share approach or accounting based model. This formula, it is only for a specific sum. Only one sum is given in our question bank. Okay, question number 26, that will solve. Okay, just look at the formula once. You might not understand much, but just hang on with it. We'll do sums. Okay, that time you might understand it better. Okay, it is very easy. Okay, just listen to me once. Yield on share approach. Intrinsic value, how you will find it? actual yield on share in percentage. Okay, we'll take a percentage and divided by equity expected yield on equity share into paid up value of share. Okay, this is the basic formula. Okay, here actual yield is equal to yield on share divided by equity share. Okay, actual yield means how much you earned in that. Okay, that also they would have given in the question. Okay, how much we should take the yield percentage. Okay, the yield divided by the total number of equity share capital. Okay, how much yield is getting on equity share capital, we are finding that. And expected yield, they would have given similar yield on similar yield for different companies in the same industry. Okay, so we'll find out. They would have given some ratios. Okay, we have to find it out. Normal yield they would have given in question of similar companies, plus risk premium of a company like 1%, 2% they would have given for our company. Like for comparison, if the similar company would be performing a certain level, if we fail to meet that benchmark, we have to add certain percentages. Okay, so that will be our expected yield. You might not understand anything, but we'll see the question regarding it. You might understand it better. Okay, we'll move on to the question number 26 of our question bank. Okay, we'll read the question. The capital structure, you know what is capital structure, right? Capital structure is the capital employed in the firm and its structure. Okay, how much is equity, how much is preference, how much is debenture, okay, everything. Okay, how much is debt capital, how much is equity capital. Okay, capital structure of Sun Limited as on 31st March 2022. Okay, this data relates to 31st March 2022 as on the year end. They have given the following formula, following information. Okay, what it is, we'll see. Equity share capital, paid up value per share is 100. Okay, paid up value is 100 and we have 80 lakhs. Preference share capital is also given here. Okay, preference share capital is also given here. Note in mind, this is one of the few sums where preference share capital is used. Okay, rest in any sum of the AFM you might not find preference share. Okay, since here only preference share capital is given. Okay, preference share capital is given 40 lakhs. 12% debentures, it is given 64 lakhs. Reserves, it is given 32 lakhs. Okay, Sun Limited earns a profit of rupees 32 lakhs annually. Okay, they have directly given profit. Okay, what is a profit? We'll see what profit it is. EBIT, net income, what it is, we don't know. We'll read further and we'll get to know. Okay, it earns a profit of how much? 32 lakhs annually on an average before deduction of income tax, which works out to be 35% and interest on debentures. Ignore this. They just wanted to, before deduction of income tax and interest on debentures, they wanted to do all of this. They could have given like this: before deduction of income tax and interest on debentures. Okay, and the tax rate is 35%, but they wanted to play with the words. Okay, we just know the information that the tax rate is 35% and this profit, it is before deduction of income tax and interest on debentures, means it is EBIT. Okay, okay, so it is EBIT only. Next we have given here it is given that the normal return on equity shares of the company similarly placed is 9.6%. Okay, this we have to put in the formula. Okay, here they are given, right, normal equity shares. For this it will be used, but we will this is the formula given. Okay, but it is basic common sense. Okay, we can solve it like that only. I will solve, we'll see. Okay, the profit after tax, okay, 9.6%, it is the return on equity shares of company similarly placed is 9.6%. okay, similar company in the industry, they are getting return on equity as 9.6%. okay, this one is clear. Okay, next one, the profit after tax covers fixed interest and fixed dividend at least 3 times. okay, so what they are saying, their fixed dividend coverage ratio is 3 times. okay, we'll have to find how much is our ratio. okay, capital gearing ratio is 0.75. this is the standard. okay, this is the standard capital gearing ratio. They have a standard of 0.75. okay, yield on share is calculated at 50% of profits distributed and 5% on undistributed profits. What does this mean? They are calculating this yield, that is their 9.6% yield. How they have calculated is, it is by no, not the 9.6%. okay, the yield they are getting, the actual yield a company should get. They are telling that how much it should be. It should be 50% of profits distributed, which means 50% of dividend, okay, and 5% of undistributed profits, which means 5% of retained earnings. okay, Sun Limited has been regularly paying equity dividend of 8%. okay, so they are saying that equity share capital, which is 8 lakhs, right, 80 lakhs, right, they are paying 8%. fair enough. okay, next, compute the value per equity share of the company assuming 1% of every 1 time of difference for interest and fixed coverage dividend coverage ratio. okay, for every difference we get, okay, we have to multiply it with 1%. okay, and 2% for every 1 time difference for capital gearing ratio. If we are getting difference, adverse difference in capital gearing ratio, then we will add 2%. If we are getting less difference, we will deduct this one. okay, now we'll see how Ajay has solved it. I'm not gonna show my notes. okay, ICA notes are pretty good. We are just going to see the solution. okay, this 32 lakhs, it was what? It was profit before tax. okay, profit before tax, here they have given. okay, and next, the interest. okay, how much is the debenture interest? If we calculate how much is the debenture interest, they are given 64 lakhs into 12%. so 7.68 so 7,68,000 is the debenture interest. okay, they have given here. okay, profit before tax we have got. Tax rate is how much? They have told 35%. 35%, if we deduct it here, we get profit after tax. okay, profit after tax. Then what is the preference share capital? After profit after tax, then we have to give preference dividend. okay, how much is the preference dividend? Preference dividend is 40 lakhs into 8%. it is 3,20,000. okay, then how much we will get? 15 lakh 80,800, 1260, 800. This is my earnings available to equity shareholders. okay, this is my earnings available to equity shareholders. Out of this, how much is my equity dividend? They have told that equity dividend is 8%. okay, so we'll simply do 80 lakhs into 8%. okay, 6,40,000 it is coming. My M minus MRC. okay, the total retained earnings is 6,20,000. okay, and the equity dividend was 6,40,000. we got it? Yes. First we needed this information. okay, for computing the fixed dividend coverage ratio, and this statement will be important for us for calculating yield. okay, how is yield calculated? Now we know this information. Here they have given yield on share is calculated at 50% of profit distributed. How much was my profit distributed? That is my 80 lakhs into 8%. Okay, 6,40,000. This was my dividend distributed. Okay, divide by into 50%. Okay, into 50%. They are saying that this is my yield. This is one criteria they have fixed for yield that we are complying with. Okay, and next they are saying that 5% of undistributed profit also forms part of the yield. Okay, so how much is my retained earnings undistributed profit? It is 6,20,000. 6,20,800 into how much? 5%. 5% 31040 M plus MRC. It is 31050. Okay, so how is yield calculated? Yield is calculated divided by the total equity share capital, right? Only the equity share capital and not reserves and surplus. Okay, divided by equity share capital. How much we are getting? We are getting 4.38 or 39%. Okay, 4.39% we are getting. Okay, on equity share capital only. Okay, if you want to understand it logically, I am telling you. Okay, if you are taking 5% on this thing undistributed profit, okay, rest of it will be transferred to your reserves and surplus. Okay, so reserves are not part of this. Okay, just 5% undistributed profit. It is the yield on the, they are asking yield, right? How much did the yield means the return an investor is getting. Okay, the return an investor is getting. So how much did he invest? He would have invested only the share capital. Okay, the share, out of the share capital, how much is he getting? That we are calculating. Okay, for that they have given the percentage of 50% of undistributed profits and 5% of undistributed profits. Okay, that we have calculated. So that's why the denominator, it was share capital. Okay, understood? Yes. Okay, now they have asked this one thing, that 1% every time for difference of interest and fixed dividend coverage. What is fixed dividend? Fixed dividend is our preference capital. Okay, preference capital is our fixed dividend. So for this, what will we take? Should we take PBIT? PBIT, it has a interest component. Okay, PBIT is used for interest, and it also has other things like our preference dividend also. But there is one thing, to distribute preference dividend you need to pay tax. Okay, this one is very important. Okay, to distribute preference dividend we need to pay tax. Okay, so tax is a component which is available for PAT. If you have to do preference dividend coverage ratio, we would have taken PAT. Okay, but here fixed interest also is added. So what we need to do, we need to take this component, that is PAT. Okay, plus we need to add interest component. Okay, how much was our interest component? 7,68,000. Okay, 2,34,000. Okay, sorry, 23,48,800 divided by how much are we covering? Okay, how much we are able to cover, divided by debenture interest plus your preference dividend. How much is my debenture interest? It is 7,68,000 plus my preference dividend is 3,20,000. So I am getting 2.16 times. Okay, how did we calculate preference coverage, preference interest and fixed dividend coverage ratio? We will take what the available also in the ratio only. Okay, See, if you see ratio, it is in basics, okay? In Ajay Agarwal's concept book, it is in basics. See, interest and fixed dividend coverage ratio, PAT plus interest, okay? Interest plus preference dividend, okay? How much are we having so that we can pay our fixed dividend, okay? Fixed dividend or fixed interest, okay? How much are we able to cover it, okay? How much income do we have so that we are able to cover this, okay? So how much are we able to cover it? And so we take PAT plus interest divided by our fixed dividend and interest coverage, okay? So we are getting 2.16 times. Next is this we'll keep it, okay? 2.16. If I tell you we can calculate now also. How much is it? 2.16, okay? How much is the standard ratio? Standard ratio is 3 times. Okay, 3 times is the standard. How much are we lacking? 3 times is the standard. How much is our company's? It is 2.16. How much are we lacking? 2.16. Okay, 0.84 we are lacking. We are lacking 0.84. Okay, 0.84 into 1%. I mean 0.84 into 1. Okay, 1% it is 0.84%. Okay, 0.84%. This is a criteria which we need to add or less in the, since ours is adverse, we need to add it. Okay, next one, 2% for every 1 time of difference for capital gearing ratio. Okay, what is our capital gearing ratio? If there is difference, we need to multiply the difference by 2%. Okay, here it was 1% interest and fixed dividend coverage ratio, here it will be 2%. So how much will that be? What is capital gearing ratio? Capital gearing ratio is fixed securities, okay, fixed securities divided by our own securities, okay, our equity shareholders funds. Here equity shareholders funds, it will include reserves and surplus too. Okay, so fixed interest bearing funds, interest or fixed income bearing funds, we can also do it like that. Okay, fixed income bearing, interest, dividend is not interest, dividend is preference dividend is not interest. So fixed income bearing securities funds, okay, divided by equity shareholders funds. So equity shareholders funds inherently has reserves included with it. Okay, fixed dividend bearing funds, fixed income bearing funds, how much is it? 40 lakhs. 40 lakhs is for preference share capital and 64 is for equity, 12% debentures. Okay, this is my fixed divided by our equity and reserves. It's 112. It's coming 0.93, 0.928 something. Okay, so what is capital gearing ratio? Capital gearing ratio is how much debt have we employed in the company. Okay, how much debt is employed in the company in comparison to our equity share capital. Okay, so the less the better. The less fixed income giving securities, the more it is better. Okay, the less income bearing securities, fixed income bearing securities, the better. Okay, so this ratio, it should be less. In fixed dividend coverage ratio, it should be more. Here it should be less. Okay, how much are we getting? 0.93. What is the industry standard? The industry standard is 0.75. Are we lagging behind? Yes. By how much? By 0.18. So every difference in capital gearing ratio, how much should we take percentage? 2 times. Okay, 0.36% should be added. This one was our earlier one. Okay, so total difference to be added is 1.2%. Okay, so now we'll calculate the expected yield. Okay, expected yield, how much was it? See, 9.6% was their similarly return on equity. Okay, their return on equity was 9.6%. This one, okay, theirs was 9.6%. Okay, so we can expect that also. Okay, how much extra risk are we taking? How much extra risk are we taking? We'll need more return. Okay, so that's why the higher discounting factor. Okay, plus 9.6. So our total expected yield is 10.8. Yes, right? It is 10.8, right? So what are they asking? Compute the value per equity share of the company. Okay, how much value will we get? This is my expected yield. What is my actual yield? My actual yield is how much? This is my actual yield. So 4.39 divided by 10.8, the industry standard. Okay, how much are we lacking? Okay, into our paid up value. So 40.65 rupees. It will be my value of equity share. Okay, it will be my value of equity share. Why is it less? Because more risk is involved. Okay, so it is trading at less value. Okay, so if you see, what we did here was actual yield. What was my actual yield? My actual yield was 4.39%, which we took from here. Okay, they have given a certain percentage rate, we have taken it here. Okay, and expected yield. What is my expected yield? My expected yield is 10.8%. How did we derive it? By this. Okay, normal expected return, the similar companies. Okay, and added our risk premium. Okay, that also logic I explained. Okay, we divide by this, and they have said that value per equity share. Okay, what is my equity shares value? One equity share is just 100 rupees, but how much is its actual value? Okay, actual value, we compare it with the outside world and our actual yield. Okay, actual yield divided by our expected yield. Okay, and we divide it with paid up equity share. Okay, if our actual yield would have been 10.8%, okay, divided by the industry standard of 10.8%, how much will be my value? It would have been 100 only. Okay, since our actual yield was less, that's why we got a value of 40.65% or 40.65 rupees. Okay, clear? Yes. Now we'll move on to valuation of rights. It is you have learned actually this in your inter accounting. Okay, inter accounting, I don't know in the new course it was there, but in the old course, the accounting paper of group 1 had this one. Okay, so what is it? We'll see. Valuation of right. In accounting time, we got this one. Okay, what is it? See, what are rights? Rights are those. Rights means issuing equity shares to existing equity shareholders of the company. If a company wants to raise capital, it will first ask to its existing equity shareholders. Okay, usually it is given in a discount. Usually, every time it is given in a discounted value than the normal current market price. Okay, it is less than the current market price. Okay, but it will be more than the face value. Okay, so how will we calculate this? There are 4 steps. Okay, 4 steps. We will not go into these steps. We will try to understand the logic behind it. Okay, steps will anyways make it is just for a reference. Okay, we'll try to understand it logically. Firstly, how will we do this one? How will we do this one? See, if a company, we are doing valuation of rights. Okay, after valuing a company, after right issue, what will be the value of shares? Okay, this is what we are going to find. Okay, so how will we do it? See, after issuing right, okay, the company's value, the company's equity share base will expand, right? The company's equity share base will expand. So it is the value of per equity share will be less if it doesn't exercise. Okay, I'll come to this part later. Okay, so how can one maximize his return or keep his wealth same when equity shares are rights issue are given? Okay, so the first step here, it is theoretical X right or post right price per share. Okay, after equity shares, after right issue is made, what will be the right of equity shares? That is price to be expected in the market after right issue. Okay, after right issue, what will be the price in the market? What will be existing? How will we calculate this? Okay, so the formula is existing MPS into existing number of shares. Okay, right issue price into right number of shares. Okay, existing number of shares into right number of into plus number of shares, right shares. Then we'll calculate theoretical value of right. It is theoretical X right price minus right issue price. Okay, what will be, when you see the example of it, you'll understand it better. Okay, for now just learn the formulas. If you want to learn formulas, I'll explain it later. Theoretical value of right per original share. It represents reduction in MPS of share after right issue. Okay, how much is the reduction of share? So what was the MPS before? Let's say it was rupees 24. Okay, after the right issue it was 22.4. The difference will be the reduction. Okay, it is the theoretical right per original share. Okay, effect we can do it also by one per share. Okay, how much was the original share used to buy one right share? Theoretical value of right, this one, divided by number of shares. Okay, or EPS, existing MPS minus theoretical X right. Effect of right on issue of shareholders' wealth. If shareholder exercises the right issue, no change in wealth, which means that after right issue, if the shareholder exercises its right, that is if he buys the right shares, there is no problem, will be no change in wealth. Okay, if he sells the right, then also there will be no change in wealth. But if he ignores the right issue and doesn't do anything, his wealth will decline. How? We will see it. Okay, we'll do question. Just refer this part. Okay, we'll do questions. You will understand better by solving questions. So we'll take questions. Okay, question number 27 we'll do, and question number 29. Okay, 2 questions we'll solve and we'll call it a day. Pragya Limited has issued 75,000 equity shares of rupees 10 each. Okay, 75,000 shares it has. Its face value is 10 rupees. Okay, the current market price per share is 24. It's currently trading at how much? 24 rupees. The company has a plan to make right issue on one equity share of rupees 16. The right issue price is 16 for every 4 shares held. Okay. So how much right issue are they willing to make? They are willing to make 75,000 divided by 4. This is the right issue they are willing to make. Okay. Now what they are asked us? They are asked us to calculate theoretical post-trade price per share. Okay. So if you put it in the formula, it will be how much? For four right shares, for 4 original shares, 1 right share will be given. Okay. So 4 original share into 24 existing MPS plus 1 right share of 16 will be given M plus divided by how many shares? Existing shares plus right issue. So how much? 4 plus 1 divided by 5. How much is it coming? 22.4. Okay. 22.4. You can do it also in another way. How is it? 75. You will take the whole value. Okay. 75,000 into 24. Okay. Plus 16 into how much? 18,750 we got. Right. M plus. And how much will be the total value? This will be the total number of shares. So how much will be the market price? 22.4. Both ways are correct. Okay, you can do anything. Okay, next one. Theoretical value of right alone. Okay, theoretical value of right alone. So how will we do it? 22.4 theoretical X right price minus right issue price. This is my right value, okay, of it alone. If you want to take it per share basis, how will we do it? We'll divide it by the original number of shares used to get 1 share. Okay, how much was it? For every 4 share, 1 right issue will be issued. Okay, divide by 4. So 1.6 is the value per share basis. Okay, this is just a false information. You can it is not really relevant here. Okay, just for a presentation we are doing it. Okay, next, show the effect of rights issue on the wealth of the shareholder who has 1,000 shares, assuming he sells the entire rights. Okay, he sells the entire rights, so there will be no change in wealth, like we saw in the theory. Okay, there will be no change in wealth. So how much will it be? Show the effect of right on wealth of shareholder who has 1,000 shares. Okay, 1,000 shares, he had how much? Earlier it was 24,000 value he had. Okay, afterwards what happened? 1,000 into 22.4. Okay, this was his value after theoretical post right. Okay, but what did he do? He sold the right. Okay, he sold the right. How much was the right per share? It was 6.4. Okay, theoretical value of rights alone. Rights was how much? 6.4 into how many rights would have we got? 1,000 divided by 4. 250, right? 250 into 6.4. So 1,600 plus how much was it? 22,400 was his earlier one. Okay, so how much he got? 24,000. So earlier 1,000 into 24, there was no 24,000 only, and now since he sold the right, how much he got? 24,000. Okay, so there is no change in wealth. Here it is given the same thing. Okay, there is no change in wealth. Next one, show the effect if the same shareholder, okay, 1,000 he was holding, but he did not take any action and ignored. Okay, what will happen when he ignores? His wealth will decline. How? We will see. Okay, 1,000 into 24. This was his original price. Okay, which was prevailing in the market. Okay, earlier before right issue. Okay, after right issue, what happened? 1,000 into what price did the equity, did the MPS become? Into 22.4, right? 22.4 it became 22,400. Did he sell any right? No. How much loss he got? 1,600. Okay, this was a basic sum. Okay. If you don't understand the logic, just muck up the formula and do it. The next one, it is the third one is quite tricky. I'll tell you how to do it. Okay. Just a game of words, nothing else. Question is just of 2 lines. Okay. So we are doing the question number 29th. Okay. ABC Limited shares are currently selling at 13 per share. Okay. There are 10 lakh shares outstanding. The firm is planning to raise 20 lakhs to finance a new project. Okay. So what they are saying that the market price is 13 per share. Okay. And they are having 10 lakh shares and they want to raise 20 lakhs. Okay. So there is no other information given. In the required part, they might have given something. We'll see. Okay. What are the X right price of share and value of right? Okay. Theoretical X value and value of right. If the firm offers 1 share for every 2 shares held. Okay. 1 share for every 2 share held. So how much? Divide by 2. So 5 lakh shares we want. Okay. 5 lakh right issue will be given. Okay. So if 5 lakh right issue is given, they are asking what is the right price. Okay. What is the X right price? So how can we find it? Okay. So 20 lakh we want. Okay. Divided by 5 lakh right issue they want to make. Okay. So how much? 4 rupees. So 4 rupees they are willing to give the right issue. So right issue will be of 4 rupees. So 4 into how many shares? 1 share. Okay. Plus, and for 2 share into 13. Okay. M plus MRC divided by how many shares we are holding? 2 shares plus 1 share we get extra. Okay. 1 share right share we get divided by 3. So how much is the theoretical X right price? It is rupees 10. Okay. Here so here 10 rupees. Okay. 10 rupees is the theoretical X right price. How much is the value of a right? So value of a right, how do we get it? Theoretical X right price. Okay. Theoretical X right price minus right issue price. Okay. So it is 6 rupees. 6 rupees is my value of right. Okay. Theoretical X right price minus right issue, if we do, we get value of right. Out of the 10 rupees, what is the value of the right? It was 6. Okay. We did it. Okay. If you want per share basis, what we'll do? We'll divide it by 2. Okay. Per share it will be 3. Okay. Next. The firm offers the next part. Okay. The firm offers 1 right share for every 4 shares held. Okay. 10 lakh divided by 4. So 2,50,000 they want to raise. Okay. So how much will be the right price? 20 lakh divided by, it will be 8. 8 will be the right issue price. Okay. So right issue price is 8. 8 into how much right share will get? 1. Okay. And how many original share is there? 4 into how much? 13. M plus divided by. Okay. So what was the total number of shares? 4 shares of original, 1 share of right. Okay. Divided by 5. So I'm getting 12. X right price is 12. Okay. Value of right. What is value of right? X right price minus right issue price. Minus right issue how much? It is 8. Okay. 4. So rupees 4 is my theoretical value of right. So if you want to take it in per share basis, how much? Divided by how many original shares? 4. It is 1. Okay. Next, how does the shareholders' wealth holding 100 shares change from 1 to 2, assuming the shareholder is exercising the right? How does the right issue increase shareholders' wealth? Okay, what they are asking is, a shareholder is having 100 shares. Okay, how will his wealth change from 1, that is this one, to 2? Okay, assuming that shareholder is exercising the right. He wants to exercise the right, he wants to buy the right. Okay, how does it increase the shareholders' wealth, or will it decline, or will it stay the same? Okay, we'll find out. So shareholder is having how much? 100. Well, the first case we'll take. Okay, 100. What is the theoretical exercise price? It is 10. Okay, what was the original price? Okay, the original price was 100 into 13, right? 13. Now what is the theoretical exercise price? I'll tell you again. Okay, 100 into how much shares was he holding? 100 shares he was holding earlier, and what was the price? Market price 13. Okay, now after the right issue, how many shares he is having? 100 divided by, so what was the first issue? It was 1 share for every 2 shares sold, right? 1 share for every 2 shares sold. So 50 plus 100. So 150 is having right now. Okay, into how much is the exercise price? 10. Okay, this is the value he has, but how much did he pay for it? Okay, how much did he pay for it? 50 into how much did he pay for it? The first one we got how much? 6 rupees, right? No, subscription price was 4. Okay, 4. So 200 he spent. Okay, 1300. He had 1300 earlier, 10 into 100. Okay, and after buying shares he got more. Okay, but he had to pay, right? So his wealth will be same. Okay, the next one, the same they have also done. Okay, third one, see, value of the firm of 1 share held, it is 1500. Okay, less amount to be acquired, it is 200, 1300. Earlier also he had 1300 only. Okay, the next one, the second point, if we do, it is 4. Okay, 100 divided by how much right share will he get? 1 share for every 4 shares held. Okay, 25. Okay, this you want to do. What was his earlier one? It was 1300 only. Before right issue it was 1300, but after right issue how much did it get? How much more he got? 100 plus 25. Okay, 125 into what was the right after X right price into 12. 1500 was the X right. It was the total price. Okay, but how much did he spend for it? 25 into how much did he spend for it? 8 rupees. Okay, minus, okay, there is no MRs, minus 1500, we get 1300. Okay, same they have given here. Earlier the value of right price was 1500, right? 1500, and amount paid to acquire shares 200. He got 1300. Wealth of shareholders before right issue 1300. There is no change in wealth. Okay, so that's it for today. Okay, that's it for this part. Okay, the next we will start with bond pricing and bond yield. Okay, so practice it. Tata, bye bye.